Hi guys, welcome to As Simple as Possible. Today we are going to discuss impairment of non-current assets. Impairment has been a very used word nowadays in accounts, and even non-current assets we know. The assets that are not current assets, they are non-current assets. Current assets which are being used for a year of 1 year period, or you can say which are easily convertible to cash, they are known as current assets. Non-current assets are assets that are like my plant and machinery, or any other asset, fixed asset, is also called a non-current asset. Impairment is that we are saying that an asset is impaired. If I have a machinery, it has been impaired. That means that the value that I am giving to a particular machine in my financial statements, suppose I'm giving it a 2000 value. Actually, the value must be 1000. So what is the impairment? It's 1000. And who said the value must be 1000? Market? Sorry. Market? Any expert? Management? Who has said that this 1000 is not actually value of this asset and only 1000 is the value? The basic equation of impairment is the carrying value. I read CV for carrying value. The carrying value of the asset is greater than the recoverable amount, which means when I go and sell this asset today, I will not get more than 1000 today in the market. So that is the recoverable amount. And what is recoverable amount? If I give you as a formula, it is the higher of fair value minus cost to sell and value in use. This is recoverable amount, which is higher of the fair value minus cost to sell or value in use. So higher of means value in use is 1000, fair value minus cost to sell is 2000. So higher of means recoverable amount is 2000, carrying value is also 2000. So there is no impairment. But if this would have been 3000, recoverable amount would have been 3000, carrying value is 2000, it's okay. Leave it. But if this would have been 1000, recoverable amount would have been 1000. The carrying value is greater than recoverable amount, impairment. Why are we saying fair value minus cost to sell? Because suppose 2000 is its fair value, but any advertising cost, etc., arranging the buyer will take 500. So ultimately, the recoverable amount is only 1500. Similarly, value in use. What is value in use? Value in use is the present value of all the future cash flows that I'm going to get from that asset. And when I add it up, that's the value in use. So out of fair value minus cost to sell and value in use, whatever amount is the greater amount, that I'll consider my recoverable amount. And if my carrying value is greater than the recoverable amount, then there's definitely an impairment. Now, if you understand theoretically, if I am an auditor, I will expect from the management that it has to determine and tell me that there are conditions of impairment. There can be external sources of impairment and there can be internal sources of impairment. What are the external sources? Market value has declined significantly. There has been negative changes like the technology has gone bad. Market interest rate on which I'm discounting has increased. Like the external conditions that have been affecting my market or my asset. These are included in external sources. Internal sources. Internally, my performance has gone bad, or I'm going through a crisis situation. Physical damage has happened to my asset. Asset is most of the time idle or it has been held for disposal. All these are sources, internal sources. So, or management has to decide and tell the auditor that yes, there are existing impairment conditions, and that is why I feel that there will be an impairment. The only problem here is that auditor has to depend on management that they will highlight the recoverable amount. Sorry again. So they will highlight the recoverable amount. Auditor, this is the auditor. He goes to audit a firm. He finds a machine that's not working properly, or it's working properly. He doesn't know whether that machine is proper or not because he is not doing that job. This is the management. Management knows everything. Management knows that there is some problem. This machine has gone bad. There's a physical damage to the machine. How will the auditor judge? Auditor depends on the management that please tell me if there are impairment conditions. Now the management is telling yes there are impairment conditions. Now why auditor is dependent again on management because management will decide what is the recoverable amount. If it says only 200 is the impairment, auditor has to take this amount. If it says 300, auditor has to take this amount. So there's a lot of judgment involved over here. So that is why auditor has to be very vigilant in this case. So this was all about impairment. I hope I'm able to explain a bit of this topic to you. Please do comment, share, and subscribe the channel, and thanks for watching.